Good morning, everyone, and welcome. Joining me today in studio is founder and CIO of Foord Asset Management, Dave Foord. Dave, welcome, and thanks for joining us today.
It's a pleasure to be here, Anil.
Dave, it's always a pleasure having you here, and I just want to start off by saying congratulations. Having started your business in 1981, just turned 40 years old last year. It's quite a big achievement.
It's been a long 40 years. As those who've been part of the journey will attest, so many different things have happened, but it's been a pleasure to look after so many people's retirement and make people enjoy a more fruitful retirement than they might otherwise have done. So I'm very satisfied with a lot of the things we've been able to achieve for those people that have stayed the journey with us. Thank you all.
Great. Dave, I've got a number of questions for you from the audience. I think many guys were very kind enough to share some of their thoughts and concerns that they're having at the moment. So hopefully we can tap into your many years of experience and wisdom.
Well, I'll try and answer them. I don't have all the answers. What I have learned over the 40 years is that there's more and more things that I don't know than I used to know, or thought I did know. But yeah, things do change, thoughts do change, processes do change. It's been evolving 40 years. Been very much a privilege to be part of it. Thank you.
Okay, great, Dave. So the first question is from Tamara, and she wants to know, what's your view of the range of returns that the All-Share Index could deliver over the next 5 years?
Well, on the All-Share Index, 5 years starting from now, we're not in a particularly expensive phase. We've had some earnings contractions in different sectors of the market. I think it's very much a resource-based index we have. A lot of the index is also subject to the vagaries of the currency. Taking all those factors into account, we're expecting returns between 8 and 14% per annum over the next 5 years from the ALSI. Different sectors will provide different numbers. And I think the returns will be a little bit more back-ended. And if you ask me to refine that closer than 8 to 14, I would say we're more likely to be in the upper region of that. So 12%. If you were looking for a pinpoint number, I would say 12%, but the range is likely to be somewhere between 8 and 14%.
Okay, thanks, Dave. So our second question for today is from Lawrence, and he wants to know about whether global debt levels are actually sustainable.
I've got a different view on debt to the standard one. Debt levels per se are not the problem. One person's debt is another person's asset. So the debt itself is not an issue. The problem with debt is the serviceability on the one level, and interest rates are very low, so debt levels can be much higher and sustain much higher levels because the serviceability is much easier. A problem comes when things change and there's a liquidity crisis, and certain people's solvency then can create a liquidity crisis, and liquidity crises can also impact on another one's solvency. And that's when the level of debt becomes an issue. And as we know, the 50-year flood comes along every 5 years or so. There's always some crisis or another, and that creates a liquidity event, which then creates a solvency event for some people who aren't savvy enough to have robust balance sheets. So in a world where everybody's balance sheet is strong, the actual level of debt, even at 130% or whatever GDP, to me, is not the issue. The issue is serviceability and whether there's going to be a wobble. And so when there is a wobble, those who've got too much debt will be a problem, but not the whole economy. But then the whole economy goes through a downturn, and that downturn is a refreshing. It gets rid of the weak players and it strengthens the other players. So market share goes to the survivors, and the survivors actually do a lot better. So the debt cycle is actually a healthy thing. So I'm not against the debt cycle. I think it's a very good thing. I'm disappointed that the Fed has tried to work towards a flat earth and has paranoid about a debt crisis, liquidity crisis. I think they're healthy, but so long as you're strong, the amount of debt you've got is fine, so long as the person's going to pay. So I have a different view on that, but it is a weakness in the system. So when you hit a liquidity crisis, be very careful and avoid those who've got too much debt. And that goes for companies and governments.
Dave, so I'm just going to ask you the questions as they come in. So we're going to change tack a little bit. So Ian would like to know, what's your take on NASPers, please?
Anil, you know I don't like going stock specific. And it's been that way for 40 years. So why do you think I'm going to change my mind today? But as a token of appreciation for the 40 years of support from different members, and NASPers being as liquid as it is, I'll give you this. It's about 40% discount to 10 cent. And 10 cent is cheap in absolute terms right now. I had a concern that the title to those 10 cent shares may not hold, but we've been through some sales in the last few years which has taken away that concern I had. Another concern I got is that the NASPers management were smart and lucky in acquiring 10 cent, but they've tried to repeat that with numerous other investments. So I've been concerned about whether those investments are going to be fruitful. And to some extent, we've been right. They haven't been anywhere near as fruitful as management were hoping. So there's a poor, or at best, variable track record on the capital allocation within NASPers. But the 10 cent portion is so big and the discount on 10 cent is so large that I'll be very comfortable owning and buying NASPers at this level.
Thanks, Dave. So our next question is from Kurt, and he'd just like to know, how do you know when is the right time to disinvest? So maybe if you can share a bit more about your sell discipline with us, please.
That's a key question. Buying is quite easy, and selling is very difficult. So how do we decide when to sell? If it's a different issue about individual companies, I still like the Philip Fisher approach, and that is you don't sell, you let management go through the cycle and make the call on managing the company through the cycle. And so the only time to sell is when you made a mistake, or when circumstances change for that company, or you find an even better company to buy and you don't have the liquidity to buy that other company. When it comes to the market, a little bit more tricky. And we recognize very early on that we're not clever enough to call the top. But I do have a problem with certain styles. There's like the reversion to mean style. That leads people to sell too early. So a lot of money is lost by selling too early because people get to target prices and things like that. I don't believe in that. It leads you to sell too soon. And markets can go up further than you expect, and they can fall further than you expect. So to avoid that, we tend to hold on and phase the situation. So part of our asset allocation strategy is to make sure we've always got some liquidity and some cash, or some items which we know that we will be able to liquidate, so that if bargains arise, then we have the cash to buy. So we always like down markets. We always like it when things get cheaper because we've always got some cash with which to buy. So when our amount of liquidity starts to shrink as a percentage of the total, then we're looking for items to sell. So that's a structural, strategic way of finding out when to sell. And the other way is to just take off 10% every now and again. But I've always been mindful that no great portfolio fails to have a great share in it, which is more than 20% of the portfolio. So if you're always trimming because a share becomes 10% of the portfolio, then you're actually selling winners. and keeping losers. So just a few ideas of why it's very difficult of when to sell, and some of the things that we think about and worry about when we're deciding how to construct a portfolio and when to sell.
Thanks, Dave. Our next question comes from Bella, and she refers to popular wisdom when she says, well, should we invest consistently in both bull and bear markets? And what do you think about that?
Depends on your style. We need to be in it to win it, so you need to be there for it. But I believe you can time the market, and you should fade it in different ways. But there's an old market saying bulls make money in bull market and bears make money in bear market, but pigs who are greedy get slaughtered. So don't try and be too smart, but you can fade, and you do want to be fully invested in a bull market, and you don't want to have any shares in a bear market. But that's perfection. And as we know, some days when the market turns from bear to bull, that's a big move, and if you're not in it, you lose out on a big portion of the gain. So there's a strong case to being invested at least with some of your money all the time. And part of the lesson of the intelligent investor, which not many people pick up, is that Ben Graham was able to get the returns he got because he never went more than 70% into equities, but also he never sold down more than 30%. So he was always had something in the market, but he always had some liquidity, bonds or cash. And it was very volatile times that he was investing in. So that plays into that. He faded the bull markets and he bought into the bear markets, but he was never confident enough to go 0-1. And that's part of our investment philosophy is try not to go 0-1.
Thanks, Dave. That's very insightful. Our next question comes from Ryan, and he wants to know, basically looking at the typical client of his, I think. So with 10 million Rand, where would you allocate those funds? So what portion in local compared to offshore? And particularly in the SA component, would you be overweight Rand hedges or SA Inc. at this point?
Well, I'm assuming that it's a Rand beneficiary and that the liability is a Rand liability. And the construct now would be about 65%, 70% in equities. South African bonds are actually quite cheap in absolute terms relative to inflation and expected inflation. They're also very cheap compared with international bonds. So I've got no problem being in short-dated SA bonds at this stage. Property, I would have a very low weighting, not wanting to be 0-1 on it. Probably about 3 to 5% there. And international, weighting international, I would have about 55 to 65% offshore, either directly offshore or in so-called South African listed Rand hedge stocks.
Dave, we must actually chat about those revised offshore limits again just now. But for
Sure.
now, our next question is from Charles. And he's basically, he wants to know about your valuation methodology. And he's saying people are quite fearful of Chinese tech right now. So he wants to know, well, how does one actually value a stock like Tencent or Alibaba? And he expects that it's probably quite hard to come up with an intrinsic value for those kind of things. But how do you know what price to pay? And he says, for example, Alibaba has to go up more than 150% to get back to the October 2020 high point. So how do you think about these kind of companies?
Quite a lot to say about both of them. Again, don't like to be too stock specific, but the question is more about valuation. So I'll tackle it from that point of view. You can get to a valuation on both of them. There's a lot of information on them, and it's hard as in solid information. The point about where it came from is absolutely irrelevant. Where a stock has got nothing to do where it's going to. So it's about the company, and the valuation is about the company, and the stock price is an indication of what the market thinks it's worth, and what we think it's worth is something else. If we take Tencent's got about 20 to 25% of its value in other items, quite a few of which are listed. So it's got a big position in Tesla. It owns 70% of Metuan. It owns about 8.5% of Spotify. And it's got shares in JD.com and a whole lot of other companies. It's actually a private equity play. And a lot of that 25% has actually grown from very little. The position in Tesla is up 5 times from when they bought it. And a lot of, as you would expect in private equity, a lot of those shares are valued now, even though some of them have halved on the price in the market, are still up 50 times on the amount of money that they put in. If you strip that portion out of Tencent, the gaming business and its core business, the PE is about 11.6 times going forward. And the growth rate on that portion is mid-teens, double-digit, expected going forward. Now, the growth rate may not come through. You've got to take all those items into account, but 11.6 forward P on the core. Other items which may or may not go up or down, but there could be, how do you value the potential of new items, maybe a new Spotify or a new VIP shop in their portfolio. It's very difficult to grasp that. So the valuation becomes a little bit of an optionality going forward. So you get to the intrinsic value and then you say, well, what's the optionality worth? What are the other items worth? So with the core business on 11.6 PE and the growth above, once the growth rate is above the PE, then you've got a good investment, and it's cheap. If management comes into the issue as well, Tencent management is stable and good. Alibaba, on the other hand, we're fine with Alibaba. It's the 40 other fellows that we have a problem with. But management at Alibaba is not as reliable or, can we say, management of Alibaba is not as good as the management of Tencent. And there's been a few hiccups on some of their investments, and some of it of a reputational nature. So there's some concern there, so you want to put a discount on that. But the core e-commerce business of Alibaba is on a 4 to 5 times cash flow. They're sitting on $75 billion in cash. They're buying back shares. This year, probably 3.5% of the company is going to be bought back at very good prices. Alibaba is exceptionally cheap because the cloud side, they've been spending an enormous amount of money, and some of the earnings and cash flow have gone down because they spent a lot of money on cloud. And that cloud is not being valued at all in this process. Alibaba reminds me of Microsoft when it was $35 and they'd only been 2-3 years into their cloud program and the market wasn't thinking that they could get the cloud right. Alibaba is 40% of the Chinese cloud business. So they are the dominant player in the cloud business, and that's not valued in Alibaba at all. So suffice to say, I bought some Alibaba the other day, Friday. I bought some Alibaba, so we think it's cheap.
Thanks, Dave. And maybe just a bit of a generalization on what you spoke about now. So Malvin would like to know, what characteristics do you look for when you evaluate a potential investment opportunity?
That's all the classics. It's management, it's the moat, it's earnings, and durability of earnings, reliability of management, capital allocation decisions of management in the past and expected in the future, fairness of management. There's so many of them, and they're well documented. But the classic things are there for us. And in valuation, it's a future earning stream. Value to us is a future earning stream at a great price. And the future earnings stream needs to be in cash. All the other accounting things get in the way of working out what the cash is going to be. And we need to be aware of time differences on the cash. So whilst there needs to be some awareness of the time differences, doing straight DCF is not the only way to value a company. But changes in expected flows, changes in expected interest rates also come into how we value companies. So very complicated and dynamic process.
And Dave, maybe just one question from me, actually, just on ESG in particular. What do you think about greenwashing and some of these other undesirable practices when you monitor and analyze companies?
What washing?
Greenwashing.
Greenwashing, okay. So yeah, I've got some strong views on that. It's 100% correct that the whole community should be doing the right thing for the community. And the company should be doing that, but also the regulator should be doing that. Just passing it on to the investor who's actually not making the decision within the company is an unnecessary onerous item. So, we do need to look at the environment. We do need to be socially responsible. We do need to look at governance. But I'm appalled at how much money is being spent and made by these Johnny-come-latelys who think that they have the ability to decide how green somebody is. And with all deference to Nedgroup, we're already green, but how can some upstart suddenly decide that something's green or not? And I'll give you an example of how bad it's got. I know somebody who works in a non-for-profit organization that employs 3,000 people globally, and their main function is to promote the environment and social and governance. And their main benefactors, the main donations, come from oil and mining. And guess who they're going to say are doing very well in improving ESG? So suddenly it's not your level of ESG that counts, it's your progress towards ESG. So if you're really bad and you do 1% a year to improve your ESG, suddenly you get a very good score compared with somebody who has been environmentally friendly from day one. So yeah, I'm appalled at the way that whole industry popped up, but it's not new. We get that sort of thing in finance and the markets. It's just a classic. It's when you find when the ducks quack, somebody will come and feed them for a price.
Dave, so just another question we have here about the Rand specifically, and we know the Rand can be very volatile. So Peter would like to know, how will the Rand fare in 2022? And maybe your answer changes by this afternoon, I don't know.
No, my answer's the same. The Rand's going to be volatile. But on that topic, I have said before that the Rand will go to 100. And just to back that up with some maths, to get from where it is now to 100 is 6 and a bit times depreciation. In the 40 years we've been in business, at the beginning, the Rand could buy you $1.30, maybe $1.35, and that's 18 times. So in 14 years, it's depreciated 18 times plus. It's not going to happen in 2022, but in less time than 40 years, and in less time than half that, and probably in about 10 to 15 years' time, because the government is less efficient, the economy is less efficient, the government is basically bankrupt. The Rand is likely to depreciate faster in the period going forward than in the past. At the moment, 2022, because of the mining boom, which has helped our exports, our terms of trade have been fantastic. Despite the high oil price, the platinum, palladium, rhodium prices have helped the Rand be strong for the last 18 months. And that was just turning. So my short-term view on the Rand is now changing because of what's happening in Ukraine. If Russia's not able to sell palladium, the palladium price will be higher, maybe go higher. So the Rand will benefit from that in terms of our trade and also tax receipts, which we've benefited from recently. So the decline in the Rand will be determined to some extent by what's happening in Ukraine, and more importantly, post-Ukraine, whether there's a long Cold War and whether Russia will be able to sell its palladium to the market. So there may be even some Rand strength in the short term. But the oil price also sets that off. We're now not only importing oil, our refineries are closing, and so we're starting to import finished product, which is more expensive than importing oil. And that also has an impact on our terms of trade, which impacts on the currency. There's also been a change in foreign allowance, which has been more liberal, and that may allow for more capital to leave the country, which could also impact the rand in the short term. So, as always, lots of factors at play, which is why the rand is volatile. I hope that helps.
Yeah, thanks, David. Actually feeds quite nicely into the next question. So Greg would like to know what are some of the best opportunities outside of South Africa, and maybe just to touch on what you mentioned about the revised offshore limits as well under Reg 28, please.
Well, the revised offshore limits are now, as we understand it, merging the 10% into Africa to the others, and people can take 45% offshore. The general opportunities internationally, the American market is expensive. Europe is not too expensive, but it's got demographic challenges. But we think that Asia is particularly cheap. Asia Tech has been trashed. We've actually believe in it to the extent that we've opened an Asia fund.
Thanks, Dave. So we just have time for a few more questions now. So the next one is from Alice, and she wants to know your thoughts on the possible demise of the Western civilization in favor of the East.
That's a powerful question. And demise, it's probably a bit strong. Europe has got a demographic problem. Europe has got a problem that socialism has bankrupted the place, and they're on a pay-as-you-go system of social grants and pensions, which can't be paid by people who aren't there. So as the population shrinks, that whole structure cannot last. But I'll try and tackle the question in a different way. I think that a youngster growing up in Europe is certain that his lifestyle is not going to be as good as his parents. And that probably goes for Japan as well. When you get to the United States, a youngster now will probably not have the lifestyle that his parents had, but he doesn't know that yet. And the same applies for South America. In Africa, for various reasons, some of the lifestyle will be improving. But a youngster growing up now in India and a youngster growing up now in China can be absolutely certain he's going to have a better lifestyle than his parents. And so that leads into the answer to the question, that the East is rising, but that doesn't mean that the West is necessarily falling. So it becomes a relative game. But the big cycle, India and China were the big economies of the world before Roman times. So when you look at economic history, so in Europe, it's written for the Europeans, by the Europeans, but economic history existed long before Europe existed in the form that they were able to capture it in writing. So the power base is still the United States, and that'll last for a long time because there's military power there. And military power goes hand in hand with economic power. And a lot of wars are going on at the moment. There have been a lot of wars. There have been trade wars, there have been currency wars, all these things are going. And even right now what's happening with NATO is America pushing this problem with Russia, and they don't mind if the gas doesn't go into Europe because it weakens Europe. So there's competitive, I'll still say there's a lot of competitors out there, but a lot of it is actually war-related. But the United States is still very strong, and it's likely to be strong for at least another 50 years. I hope that helps with that question.
Thanks, Dave. That was very insightful. The next one is from Philip, and he would like you to please comment on the ability of cash or income funds to outperform inflation going forward.
Well, cash is unlikely to outperform inflation. Inflation bonds will outperform inflation. but they have a technical quirk in them. And they don't always do that at every level. Depending on the movement of the real rate, the inflation bond is likely to give you a higher or lower return than you were expecting. But definitely inflation bonds over cash. But just like to reinforce the point on cash. We invest a lot of money in cash, but we don't invest in it for that return. We keep it in cash because we know when things are cheap, they're cheap because other people don't have cash. So having cash when people are forced to sell items, not because of valuation, but because of liquidity, then we want to have cash for that. And that's where we get the return, not from the running yield on the cash.
Thanks, Dave. That actually feeds quite nicely into our final question for today as well. So, as we know, markets have pulled back a little bit this year already, but Ronel would like to know, do you foresee a major market crash this year?
Forecasting is always dangerous. So forecasting a major crash it's the widowmaker. So I'll say there's no major crash this year. The rising interest rates means it needs to be retracement. The expectation on earnings is probably a little bit high and needs to come back. So the S&P is on 18.5 times forward earnings. Those earnings are probably a little bit overstated. So it's probably on a 19 to 20 over the next 2 years on expected earnings because there's been a lot of catch-up post-COVID and things like that, which are exaggerating some of the earnings now. But as the discount rate goes up with interest rates, you'd expect that PE to come down as well. So I wouldn't be surprised to see the S&P down 20% this year. But in terms of it crashing like that, I suspect not.
Dave, brilliant. That was really fantastic. Thanks very much.
My pleasure. Thank you all.
Yeah, it's always a pleasure to have you with us and to see you.
Thanks, Anil. Thank you all.
Thanks to everyone for joining us on the call today, and particularly to those of you who sent through your very insightful questions. Best wishes and stay safe.